Good morning. Welcome to YX Insights. Today, we're going to start off with the FOMC projections after yesterday's hot PPI. We're going to look at SP 500 seasonality, as well as the latest performance of the indices, major assets, and Mag 7 stocks. And of course, we're going to go through the charts one by one. All right, so let's get started. So the latest FOMC decisions, priced by the Fed Funds futures, still project a 5-cut scenario for the next 12 months. So the market has been deciding between 4 versus 5 cuts since the non-farm payrolls. That was significantly below the expectation in terms of the actual data as well as the revisions. The latest PPI data has swung the door towards just a certain 25 basis point cut in September, a likely cut in November, but not a done deal, and also a very likely cut in December, as opposed to 3 very certain cuts between September and December, or the 50 basis point cut option that some people think could happen. So after the PPI, the market is scaling back those very dovish expectations. Why does the hot PPI matter? So the PPI is the producers' price index. So the rising PPI shows that producers are passing on more of the tariff costs into the wholesale prices. And of course, those people who are buying from the wholesalers now have a decision to make whether they want to pass on all of the costs onto the consumer pricing. If they do, so the CPI in the next 3 months could see ticks up, especially in the goods inflation section. And that's not something the Fed wants to see. If they don't, their profit margins will get bitten. So you can see weaker earnings in Q4, or possibly Q3 as well, which will be reflected in the beginning of the year earnings calls next year. Now, what do you do if you are the Fed? The Fed has been off the stance that the tariff cost could be a one-off cost. So you will see one hot reading maybe in CPI, let's say in September or October, but the subsequent readings won't be as aggressive. Secondly, PPI tends to lead CPI, but it's not a for certain done deal. So the Fed wants to see more data to say, okay, we are definitely seeing a tick up in inflation in a persistent manner, therefore the rates should stay high. Or if the non-farm payrolls take priority because unemployment rate is spiking higher every month, then that could take priority in terms of rate cuts. And in that case, the Fed is just praying that CPI doesn't shoot higher and we are not in a stagflation scenario. So the Fed really wants to see more data to be more certain before they make any drastic decisions. Is this the right approach? Some people have debated that the forecasting and the forward projection method is more relevant. Because if you're data dependent, you're really dependent on data that is a lagging indicator of the economy that are 3 to 6 months out. But historically speaking, the Fed did use forward projections before 2019 and it didn't work because every time they cut rates, they expect inflation to shoot up and then they moderate the rates to higher levels, expecting inflation to be back to 2%. It didn't happen. And actually, historically, inflation was consistently undershooting the 2% target. And that could be because of the technology shift that's making everything cheaper, or it's just the Fed is not very good at doing its job. But that is more of a philosophical debate for the economists. From here, I don't think that larger context is relevant to the near-term price action, but it is very useful for understanding the world around us. Looking at the Treasury outright yields, so if you observe this yield curve, the near end, we're looking at the 1 year at 3.9%, but the 30-year is almost a full percentage point higher. Why is that? So what the market really expects is that once we get the rate cuts, we're not going to get to the full neutral rate, which could be something like 3% or 2.5%. And actually, the market thinks we're going to be back onto the hiking path as soon as we touch the 3% mark in the Fed funds, as you can see here. So actually, the more aggressive the Fed cuts into a strong economy in the front end, the more anxious the market will get about inflation in the longer end. And secondly, because of the expanding budget deficit, the White House has shown no restraint, especially with the passage of the One Big Beautiful Bill. We are really not going to see the national deficit coming down as many people wanted to. The strategy is now to grow the economy. GDP goes much higher. We can still reduce the budget deficit relative to the GDP because of the high base factor. That's the thinking anyway. But the reality is that investors are still very much nervous about this whole flood of supply coming onto the loan and the Treasury market because the government trying to issue more bonds, borrowing money. The imbalance of supply versus demand means the yields should be higher to compensate for this supply risk. So that is the term premium. Investors demanding for higher yields for the longer term maturities in order to compensate for the changes in the interest rates over that horizon. So I don't think that factor is going away anytime soon. The Treasury is trying to respond by issuing more short-term notes and bills to essentially reduce its duration swap, so swapping out of the long-term bonds into the short-term bills and rates in order to keep the long-term yields anchored. It is a trick that the market is now seeing through. So how effective the Treasury can do this really depends on the skill of Scott Bessent and also how much lower the front end can go for this option to remain attractive. Now, looking at the SPY seasonality, so the S&P 500 ETF. So what I've done here is I've mapped out past 20 years, every single day, the forward 10-day returns. So looking at today, it's the 15th of August, the forward 10-day trading returns is plus 0.4%. It doesn't sound like a lot, but actually, if you think about on average, SPY only grows 10% a year. So 0.4% is actually fairly bullish in terms of the next 10 days. And green is obviously good, and orange is a deep red territory. We're looking at negative returns. September is pretty bad. If we're looking at especially mid-September, the forward 10-day returns are deeply negative versus in July, which is seasonally a very strong month, or end of June is quite strong. So August, between now and the end of the month, and even into the first week of September, is still pretty benign. We see seasonality-wise, we should still be expecting flat to positive returns. But going into the second week of September, things will get much tougher. So print this out, high no walls, just bear in mind when to scale back risk. Even if the seasonality doesn't play out, it's like the wind. It just gives you an idea of what are the investors looking at, what institutions are looking at in terms of flows. So you can at least have a sense of idea of if things start to look weak, okay, now maybe it's time for risk off and scaling down the positions. Just looking at the 1 month performance of cross assets, SPY QQQ, pretty strong month, up 3% and 4% each. This is just 1 month period, so pretty good returns in September and early August. Even the small cap IWM is up 2% in the past 1 month. Bonds also up 2%. Oil has retreated from the high, so now I'm turning more bearish on oil because of the technical structure. Gold flat, dollar flat, and actually Bitcoin has underperform in the 1 month period. Also looking at Max 7 stocks, in the past month, the best performance is Apple. So the White House announced that Apple is going to invest an extra $100 billion on top of the $500 billion they said they would into US onshore in the next 4 years. So that is regarded a bullish signal for Apple, but in reality, Apple was trading within the range. And I think what was happening is that you can see that MSFT is actually lagging in terms of performance. People have rotated out of the previous leaders like Microsoft into the laggards like Apple and even Tesla, which is up 6% in the past month. So I think there's definitely a little bit of a rotation going on. People who are previously on the sidelines probably don't want to chase any new all-time highs. And what do? They look for the names that haven't underperformed but are due a breakout, and they rotate into those names. So that's why I think is happening at least this week. Looking at SP 500, SPY. So what we are seeing is SPY pushed above the 176% extension of this wave one. So it's very, very bullish right now. And this is now into a more stretched territory for wave three. So typically we would expect wave three to be around the 1.38 to 1.76 extension of this wave one. But because of the liquidity we're seeing and investors being wrong-footed back here and now starting to chase the market, they're starting to worry about the underperformance in the second half of the year. They're coming back in, buying the very shallow dips and pushing this wave three higher. Could it go to 660, which is a 200% extension? I can't rule it out. At this stage, the question is why not? What's going to give? We've had weak non-farm payrolls here. Investors bought the dips. We've had hot PPI yesterday. The market recovered. So this bullish trend is very strong, and it could last into September before we have FOMC. So until this trend line is broken here, I would not bet against the market. I would not short the market here. Similarly, QQQ actually already approached the 200% extension of this wave one, so it's been ahead of SPY. It shows the investor appetite is very strong in this market. Again, unless it breaks below this trend line, I wouldn't really mark it as the start of wave four. I think we're still in a very strong wave three trend. And of course, it could consolidate flat lines in the next few weeks. But unless it breaks below this, I'm not in the mood of shorting it or calling it a wave four. Looking at oil, so there has been a change to my outlook for oil. For a while, my outlook for oil has been torn between the fundamentals versus the technicals. So fundamentals is saying that 2 million barrels per day is coming into the market in terms of supply in 2025, when the market, the global economy only needs about 460,000 barrels per day in addition for 2025. So in terms of supply versus demand, the imbalance is very strong to the downside. So the prices should be weaker because of the extra supply. But because of the geopolitics and the conflict around the Russian-Ukraine and the US sanctions for those who deal with Russia, and also the Israel-Iran conflict, investors in oil have been quite anxious about the supply shock coming out of those regions. So that drove oil prices sharply higher between May and June. And we also saw another retest towards the highs, but it didn't go through in July as well. Now, looking at the longer term, I do think we are pretty much in a range-bound, very wide range-bound sideways action. And over here, I would really say that I don't think really detailed technical analysis or even machine learning is that much more useful than the ranges we have drawn here. So in this very choppy sideways move, the best thing you could really do is just sell near the top and buy near the bottom and doing some mean reversion trade, because that's been the regime for the past 3 years. And of course, you have to be ready to switch your strategy if we see a breakout. But until that breakout comes, I would say mean reversion within this range is probably the best trading strategy right now. So if we do play the technical analysis here, I would say that our previous expectation for the 5 waves has been invalidated for the upside. Now we're likely to be in this ABC wave for a wider WXY structure, connected structure, where this C wave could have 5 waves. So we have the wave 1 here in the June low, which was held by the 200-day moving average, and then wave 2 retraced, tested the highs, didn't get above it, and now we're probably in the wave 3 downside, which could reach below 66 next. So that's my near-term expectation. So it's turning more bearish than before, but it aligns with the fundamentals. So I'm fairly comfortable with this read. Looking at the 30-year yield, like I mentioned at the beginning about the yield curve, there's still a very strong risk of a high term premium for the long-end bonds because of the supply risk that the White House, the Treasury, is bringing in by expanding its budget deficit. So for now, Treasuries have been moving in a sideways action, and we've had higher highs and higher lows here, and this dip here in the yields, beginning of August in the non-farm payrolls, expecting the rate cuts, was also held above this July low. So for now, my uptrend read is still in play. So I haven't changed my mind about where the yields are going. My opinion is probably in the minority camp right now. From what I read, I think a lot of people are still very much bullish in bonds. But my read is that I think in the medium term, the risk of high term premium and also the inflation-driven risk, it hasn't gone away. So I'm still putting in this as wave 1, wave 2, and wave 3 in the 5.5% region. What could change my mind if we reliably dipped outside of this channel? I think that would be the first sign of a break in the structure, and then I'm forced to have a rethink. But just looking at the overall long-term trend, and we're seeing this upward drift and upward bias for yields, it's hard for me to come bearish on yields, which of course is bullish for bond prices. So now we're looking at TLT, which is almost the mirror image. So I'm still bearish for TLT here. I know there's a lot of volumes of accumulation in this region, so I recognize that. But given the macro factors, I still think the bias towards a downtrend, and especially if you look at the price action, with getting lower lows in the recent days and lower highs as well. So until we get a breakout over this trend, I'm still bearish in the medium term. So looking at Bitcoin now, we tested this all-time high this week, and it almost seemed very promising. We're going to directly move towards the wave 5 target of 127K plus. But what I did notice from our seasonality analysis was that late August is a slightly challenging period for Bitcoin in terms of the flows. So I was a little bit torn on whether we could attack this high directly, actually. And yesterday we saw a wave of liquidation of the leveraged loans on the crypto exchanges that essentially brought us back to this range here in the 120K range here. So I would say that maybe a little bit more patience is warranted as we consolidate and try to build our new base here. But I am still optimistic that the next major move is to the upside, towards 127K plus. It could even reach 135K. And after that, I have marked it as a wave 5 of wave 5. So this is my overall cycle top expectation. But I think it really depends on how that price action actually play out once we get here, to see if we're in an extended move, and maybe I could alter my expectation to higher. So, but I need to see evidence first. So for now, I will say be a little bit more patient. We are still on track for this wave 5 high target. And once we get there, we can assess whether we get higher or that if that isn't. If we introduce Ethereum, for now, we are looking at a wave 3 move in the past 2 weeks. So what we're seeing is that it's now approaching the 1.38 extension of this wave 1, which lands us in the 5.6K area, and it could stretch even to 7K. It doesn't mean we're going to get there tomorrow. I know it looks like a very smooth line, smooth curve, but in terms of those levels, there are always going to be hiccups on the way. We could get a little bit of consolidation here with Bitcoin before the next leg higher. So I'm pretty bullish for Ether as well as Bitcoin, but I just think that we shouldn't get too far ahead of ourselves in terms of the timing. Looking at gold, the price structure isn't bullish or bearish, so it's pretty neutral right now. We're looking at a lengthy sideways action since April, and also RSI has just been oscillating around the 50 mark here. So we don't really have a good read on when it's going to break out. There is definitely a lot of volume in this zone, which I don't think is distribution. I think is pretty even in terms of what we're going to see, and I still expect a wave 5 higher at some point, but we just need to wait for gold to break out of this range first. And also there is a bearish chance that we could turn down here for a wider flat in wave 4. As long as the gold stays in this region, both paths are quite balanced right now. So for me, it's just about watching the price. So Apple broke out of this sideways range after the White House news, and now is attacking the 1.382 extension of this wave 1 in wave 3. So for me, I think this signals a wider rotation play from other previously bullish names into the lagging names. Amazon. So when Amazon traveled down here, I did think this was a buying opportunity here. I wrote that in my newsletter, and our signal was switched off to risk off just for 1 day, and it's been risk on since this green candle here. So that's been pretty constructive. I did expect this gap to get filled quite quickly, which has happened, and I do think that the near term is higher for this wave 5 towards 250. So the thing you have to remember about Amazon is that I have seen comments on FinX is that Amazon is rising 2.5% because they announced the delivery for groceries in the US. What you got to remember that the great majority of Amazon's valuation comes from AWS. AWS business on its own, growing at 17% year on year, is worth at least $2 trillion. And if it can accelerate, it'd be worth more. So it's worth almost the entire market cap of Amazon. Everything else in terms of the e-commerce, all of that is much lower margin business, which is great because that's where Amazon came from when Jeff Bezos started out building the empire. But they don't really contribute meaningfully to the bottom line like AWS. That's why the previous head of AWS is the current CEO of Amazon. They recognize this is the biggest factor. And what AWS is doing differently to other companies is that it's trying to make its own custom chips that is higher price performance. So what that means is that it actually is a lot cheaper than NVIDIA chips, for example, or AMD chips. But in terms of the price for your buck, in the performance you get, it is justified. So not everyone needs this very top-notch NVIDIA chips, and you could actually pay a lower fee to Amazon for to get the sufficient performance you need, but at much lower price levels. So they're pursuing a slightly different in-house strategy. And I think the problem with Amazon is the CEO is not charismatic enough for selling Amazon story. He's not very good at articulating the value proposition of Amazon compared to someone like Elon, who is always selling the future dreams of Tesla in terms of robotics, robotaxi, Optimus, and keeping the valuation of Tesla at a sky high level at all times. So I do think Amazon is a very good stock. It's arguably undervalued, and I do think the near term is getting back to 250, getting over this all-time high that we saw back in February. So Google has done a better job than Amazon in reclaiming this all-time high back in February. And what we're seeing is now we're pushing towards the extended path of this wave 3. So what I see is this is a leading diagonal structure. We have 3 waves in each of the 5 waves. And this wave C is now trading just between the 100 and 123% extension of this wave A. So that's the normal target region. In the near term, I do think we should get a retrace. We could push to 208 and then get the retrace, but the risk reward is biased towards the downside in the very near term before we get a wave 5 higher. So I do think if we get a pullback towards below 190 or even 180 region, that's a very good buying opportunity for Google to get ready for this 5th wave. And for the classic technical analyst, you could say this is going to be a cup and handle pattern where you get the cup and you get the retrace here for the handle before you get the next leg higher. For the long-term holders, Google is still very attractively valued in terms of PE ratio and PE ratio adjusted for growth. It's the best value among the Max 7s. So when we get the pullback, I definitely think it's a very good opportunity to buy Google. If we can get the 200-day moving average, that's bingo for us. So I'm bullish for Google in the medium term. I'm just expecting a pullback to arrive at some point. Meta, a very similar story, is trading in the top region for this wave 3. So this wave 5 can trade up to 800 or even 820 at a push. But I do think the risk reward favors a large degree wave 4 pullback here. And Meta has done very well since the beginning of 2025, even after the roller coaster. Is one of the best performing Max 7 stocks year to date. Microsoft, it has pulled back from this post-earnings high. And what I did think was happening is that we have very large block trades coming in every single day throughout this earnings period with a goal to complete by this earnings report. So now this earnings report is out of the way. If you look at the Microsoft in terms of valuation, is very stretched, even more stretched than Apple in terms of growth adjusted valuation levels. And now we're being putting back since this post-earning high. So I think we are seeing a wave 4 pullback, even though it doesn't seem that dramatic. And my expectation is really for it to reach 500 at least as a minimum for this wave 4. And it could be as shallow as that, to be honest, because this wave 2 was quite steep. And we should get a wave 5 higher subsequently into the 600 plus region. So in terms of value, I don't think Microsoft is great right now compared to its peers. And in the near-term price action, I do think we warrant waiting for a pullback here. NVIDIA, this run has just been incredible. It's more than doubled from the April low here. So we are in a wave three, and this wave three has pushed above the 200% extension. So that is quite stretched for me. Of course, the next level would be the 238% extension and 195. But the risk reward is just not great. I think the risk reward hasn't been great since 162. But in this very bullish market, the uptrend can ride forever, which is why I don't like shorting in the bull market. I don't really like suggesting shorting ideas because the overall market liquidity out there and a lot of people being on the sidelines here now getting the FOMO and then trying to buy in July and chasing the seasonality. It's really hard to say, okay, we've definitely going to top because of this level or because of that level. I think the best thing we can do is just wait and observe when the trend breaks and try to pick up shares when we get a sizable dip that looks more attractive. Also need to mention that this last 10 days of August and also the first week of September is very volatile for NVIDIA because of this earnings data around it. So it's historically, that period is the top 2 or 3 most volatile periods given NVIDIA's history. So I really be a bit cautious in sizing too hard with my trades here either way. Tesla, people don't believe me when I'm bullish on Tesla and think it will move up in the near term. So it has taken a bit of time between this wave 3 high and where we're now for the next leg of breakout, thanks to Elon tweeting about Trump, talking about New American Party and all that. But on the bright side, if you look at how resilient the stock has been from the damages his tweets had done, and now it's become quite insensitive to the politics. It is quite obvious that the path of least resistance is actually upwards, not downwards. For the bears, I really wonder, if falling out with Trump wasn't enough to break the stock, what's going to give? The thing about robotaxi is that it is such a sexy proposition that Elon has managed to hold on to the narrative and delivered over the past few years, even though it has been late, that it has managed to keep the stock at insane valuation levels. If you're looking at price per sales, price per earnings, Tesla as a car company just doesn't make sense at all. But if you look at Tesla as a world dominating automation, transportation company and robotics company that's going to capture a great amount of market share in this new wave of physical AI, then it makes a lot more sense that Tesla is trading at this current price point and with room to even move higher. So in terms of the price technicals, I do think we are due a massive breakout very imminently, and I think this wave 3 target actually could be delivered within the next month. It is a substantial jump from here, but if you look at Tesla's history, when it does make the big jumps, all of these moves happen within a few weeks, essentially. From here, this is the robotaxi event jumping to the 270 mark. That didn't take more than a week. And again, from after the US election, we got to the 350 mark within just a few trading days, really. And also ultimately to 480 mark in about just 6 weeks' time. So when Tesla rallies, and equally when Tesla dives, it doesn't take long at all. It's this long drawn consolidation periods that is wearing people out and getting people to sell their shares before the big moves. And actually, when most people are done with Tesla, they're bored with this sideways action and give up on the stock. That's when Tesla pops because there's no more pressure about its performance. Semis ETF, I thought we could have started wave 4, but actually given the strong price action in NVIDIA, AMD, and other semis, we are still in wave 3. So really, I think we just have to wait for NVIDIA to start moving down before we can decide whether SOXX is also moving in wave 4. So 200% extension versus wave 1, it's quite stretched. I wouldn't chase it here. The risk reward favors waiting for a dip instead. Palantir, what a great stock. We have been pretty bullish since using a combination of machine learning, but also tech analysis, since we've been covering this in April. So now we're here, this wave 3 is a little stretched. It could push higher, just like other stocks, but the risk reward favors a wave 4 pullback here. If it does pull back, I think it won't be that steep a pullback. It won't be the Andrew left saying, 50% drawdown straight away. I think we can get a pullback into the 140 region to 150 region, and then another wave 5 higher to round off this entire cycle. After that, after we get to 220 above, yes, maybe we will get a big shock for valuation correction, but we're just not there yet. So I would urge the short sellers to at least be patient and wait for the actual evidence of the stock price collapsing, because if your thesis is correct, you don't need to catch this top region. You can wait for the trend to establish itself and still catch a very bad profit on the way down if your thesis is really about valuation correcting to normal levels. So that's it for today. Thank you for joining me today. Any questions, please leave a comment and ask me in Slack.